Hello, everybody. Welcome to another episode of our Mosaic podcast. It's the 5th of May today. We have to say that just in case things change after today. But thank you for joining us again. You are joined by myself, Mandisa Zavala, the head of asset allocation at Alexforbes, and the beautiful, stunning Phumile Piane, who's our chief economist. We hope you enjoyed today's podcast.
Thank you, Mandisa. Can you believe it? We are 3 months into the war now.
Yeah.
Far out from initial thoughts where, the market narrative was this is going to be short-lived. Last month we moved to, this looks like it's going to be a lot more protected. What's been quite interesting is that, 3 months into the war, traffic through the strait remains 95% below pre-war levels. We have this fragile ceasefire, but it has not changed those dynamics around the strait, right? And as a result, oil prices have inched higher, relative to pre-war levels. When I was looking at the data earlier this week, it, was showing that oil prices are up by about 70% relative to pre-war levels, right? So, that's a steep increase. And essentially what that has meant is that the inflation backdrop has deteriorated. And it's not surprising that we have seen a lot of central banks turn a lot more cautious. Like when the war initially broke out and we had those meetings, central bank meetings in March, right? A lot of central banks turned quite cautious, essentially saying that they need more data to assess the macroeconomic impact of the war. But what has become a lot more clearer now with more and more meetings that we've observed is that, yes, they're cautious, they're worried about the macroeconomic impact, but they're also worried about inflation being a lot more persistent. What's been interesting also is just to look at some of the modeling that various central banks have published. Everybody has essentially moved to scenario analysis to say, what happens if, the war is a lot more protected? What happens if we see the severe damage to infrastructure, right? To try and assess where inflation is likely to go. And what we are seeing is that most central banks are saying, yes, there's not much we can do about a supply shock. But if inflation becomes a lot more persistent, then they are going to have to step in to increase policy rates, essentially, to ensure that inflation expectations remain anchored, right, at inflation target levels. So that's literally been what we have been keeping an eye on during the month of April. And what we have largely observed is that the macroeconomic environment is continuing to turn. Now, if you think about it, it's a massive change, right, from the beginning of the year, where we were talking interest rate cuts. Last month, when we spoke, we were talking, no further easing, central banks likely on hold from here on. But, the market has went even further and is now pricing, interest rate hikes. If we look at the pricing for the European Central Bank, for the Bank of England, expectations are that both banks are likely to hike by 50 basis points this year, right? Which is at that massive change in the macroeconomic environment. What's been quite interesting is that on the U.S. Fed side, expectations have essentially oscillated, still for one cut to a hold. And, that's just premised on the Fed's dual mandate. So the Fed is, equally sensitive to inflation as well as labor market dynamics. And job growth in the U.S. has essentially flatlined over the past 3 months, right? So it's no wonder that the market is a bit indifferent about which way the Fed is going to lean. But even at this last meeting that the Fed had at the end of April, you can interpret it as slightly hawkish. Yes, you did have a two-way dissent to the decision to hold, but we did see 3 members essentially, dissenting to the use of easing bias being maintained in the statement. So there are MPC members there that are worried about the inflation backdrop deteriorating, even though the labor market also has flatlined a bit. So at best, no further easing from the Fed and a hold, but we are worried about that further deterioration in the macroeconomic backdrop. And what's been quite surprising for me is how the market has just essentially shrugged off this deteriorating macroeconomic backdrop. Like, how do you make sense of it?
There's no sense, I think, in a lot of what's happening right now. I think I'm also struggling as well to piece things together. I think to elaborate exactly what you're talking about, we had a look at the VIX earlier, and we're identifying how it's actually it's at one of its lowest points, and even below its average level since 2018 or 2019. That's massive, given the fact that, like you've explained, we are still on season 3 of the war.
Season 3.
We're still, it's month 3 of the war right now. Yeah. But also, it being month 3, it's also changed the dynamics around our expectations for monetary policy and inflation going forward. So you'd expect that some of those dynamics would start to show in markets becoming a bit more jittery in holding risk assets, but it's not necessarily that case. If you look at some of these signals, we become concerned because, yes, oil is still elevated and the traffic through the strait is far from it being normal. So when you actually try to decipher what the market is trying to say by it shrugging things off, is perhaps it's trying to say that this is a shock that's painful, but it's actually manageable. And I think that manageable part is the part that you're saying, even central bankers are starting to debate as well, and they're starting to caution market participants about, to say, perhaps, we need to consider the fact that this might be protracted and might take a bit long. I think one of the other things as well that I've noted as well, outside of just market sentiment, is also earnings coming out and actually pricing a lot more higher. If you look at some of the key markets that have printed earnings over the last month, or some of the estimates that have been done by analysts, what is interesting to note is actually earnings are being revised higher. Wow. And again, that also is puzzling, because what is a reality right now is us being in month 3 of the war, is that we are going to get some inflation pass through that is going to come. So that's no longer debatable, that we're no longer in week 2 where we can debate that. It's going to come through. But it's almost like that is not being considered at all. And some may argue that perhaps maybe there are some sectors and industries that are far more robust and could potentially do well. And I think we can definitely take that argument. But I think for me, the concerning side is that you're even seeing markets like Europe, which from an economic perspective are expected to struggle with inflation, and potentially you're going to expect some interest rate hikes, like you said, from the ECB there. But even those markets are getting revised earnings that are going higher. So it's definitely an environment that is maybe alarming might not be the right word, but it's puzzling to say the least. I think some of the things that maybe we can look at and say, what is the market getting right? What may the market be underestimating? Like you said, we are at a point now where we've now had talks around a ceasefire. So that means the left tail war risk has been eased. So we can definitely say that's why we had recent increases in the stock market, because we have seen the stock market go up from its lows after the market. It also is appreciating that perhaps right now we're in an environment that we're going to see some fiscal normalization, but I think it's expecting that fiscal normalization is going to rebound quicker than expected, which is not something that we're thinking of. And I think this current environment is then saying that perhaps we should consider that beta is not one of the things that you're going after. I think from us sitting on the asset allocation side, we're always concerned around, is it a beta market or is it an alpha market? And I think it's kind of challenging the beta side of things because you're moving into, the further we get into this non-ending ceasefire on and off, straight as open or off, it makes it difficult and much more riskier, such that you don't have enough cushion anymore. And in environments where we don't have cushion, you need to sort of be a bit more active. So really, this current environment is calling for the active investors, and us as multi-managers, we sort of benefit from that because we invest in managers that are that, but we also, when the time is right, we'll also invest in passive managers. So what I will close off by saying is that it is not a market that is without opportunities. I don't think that should be the key message that is taken away from our conversation, from this talk. We just think that there is a selectivity that is happening right now. And a good example is, for example, you have your commodities. That is still actually well bid. If you look at the fundamentals in the short term as well as the long term, you still have those supply-demand imbalances that are likely going to keep that market prices still holding up well, but also over the long term, it ties in with things like the AI trade, which continues to be in vogue. You need some of these commodities to continue. So you have that. You have infrastructure, which is also tied to the AI trade as well. So what I'm trying to say is, there is a lot of ways that you can still maneuver the current market and the current environment to still benefit the portfolio over the long term. However, it's becoming a lot more granular. It's no longer as easy as it was, I think, when we started off the year, where both, monetary policy, fiscal policy, everything was shooting the lights out, and we were just expecting that beta would be the way to go. And I think perhaps maybe then it might be key for us to sort of appreciate and find out what's happening to South Africa. I'm interested to know whether your views have changed on SA, because you've just spoken about the global environment and touched on the fact that, from a macro perspective, you guys are becoming a lot more concerned around inflation. Is it the same way in SA, or has something happened to make us more influenced?
Have we found oil?
Have we found oil some way?
No, unfortunately not. I don't know. Maybe in the past hour. I don't know. No. I mean, unfortunately, the SA macroeconomic backdrop is also pointing to some deterioration. I mean, we've had 2 consecutive months of fuel price increases, which is going to be inflationary.
Which I've heard.
Right, exactly. I mean, if you think about it on the petrol side, so petrol has increased by like 6 rand now. So, if you're driving a petrol car, you've been a bit cushioned there. Diesel has had, steeper increases, right? Even with the fiscal support measure that government announced, right? So the inflation backdrop has deteriorated. We do expect that oil prices are going to move even higher from here on, given that, traffic through the strait has not normalized. The market has so far, dipped into, various reserves, but, there's only so much that you can plug the hole from, right? And our expectation really is that if, that traffic does not resume, oil prices essentially will continue moving higher. And when we look at our inflation profile, essentially we see inflation peaking at about 5%, which is a long way from the 3% new inflation target that the SARB announced last year, right? And in that environment, as I was saying, on the global side, we came from expecting cuts to a hold, and we're now talking monetary policy tightening. On the SA side, if you think about it, we came into this year expecting 50 to 75 basis points worth of cuts. Last month when we chatted, we removed those, and now we are actually now talking about 50 to 75 basis points worth of tightening. And we think those hikes can come as early as the May meeting. So that's, the environment we are in, given the deteriorating macroeconomic backdrop, and that also points to a headwind on the growth side. Growth had just recovered last year we were talking about 1%, 2% in 2028 was looking a lot more feasible, and all that is now being challenged, and we actually worried that we may get sub 1% growth again this year, depending the hit that consumers are going to have to contend with. I liked what you mentioned on the global side, that despite this deterioration in the macroeconomic backdrop, it does not mean there are no investment opportunities. I'd be very much interested in your own outlook. Has your outlook changed on the back of this change in the macroeconomic backdrop?
Definitely. I think it's troubling, to say the least, that unfortunately the environment is not as constructive as it was at the beginning of the year. I think now that you've talked about the penciling in of about 50 to 75 basis points of hikes that are potential for the rest of the year, that becomes something that not only consumers need to contend with, but businesses also need to contend with. The reality is we do have, we sometimes have discussions around the macro is not the market. We'll have that. The reality with South Africa is that it's probably a lot more closer to macro. The market is a lot more closer to that. If you look at how South Africa why South Africa did well over the last couple of years, you'll understand that some of it was correlated with some of the improvements that we saw on the macro side. So a lot of things have been, even the conversation around a low inflation target is actually what prompted even our bond market to actually perform really well, and also came into South African Inc. as well. So there's a lot of parallels that you can draw from the economic side to the market side. So whether we like it or not, that does hinder, or the issues that you've spoken about do hinder and pose headwinds on the market outlook, especially the earnings outlook. The reality is when we look at the sector earnings expectations going forward over the next 6 months or even over the next 12 months in South Africa, those still remain quite robust. Right. What is interesting, though, to note is unlike the global environment, South African markets have actually fallen by a lot more. So they took a big hit after the war was announced, and even when we saw market sell-offs happening, South Africa was actually on the receiving end of that, and very badly hit so. And when you look at the year-to-date performance of South Africa, or at least performance since the war started, you can still see that there is some impact there. So we can say from a price perspective, it hasn't really priced out completely the effects of the war, like we've seen in the market, where some markets are even up now since the war, where they've completely priced out the risk of the war. So I think that we can see that as a cushion for SA. And this is where you now try to find opportunities, because you say SA still, it's sort of that risk premium has taken into account some of the risks. Maybe you might debate how much of that risk is truly in the risk premium, and that's where we can, differ or debate depending on what your view is. But I do think that offers a cushion that the global environment doesn't have for South Africa. So valuations are not at all stretched. You're not contending with a market that is too excess in terms of expectations. But with that being said, where we were expecting the lion's share of earnings to come from was South African resources or even basic materials. And that, we're expecting when we started off the year, the number was close to about 100% of earnings expectations. That's been re-rated down, and now that number is more closer towards your 75, 76%. Still high, and you can understand why, because again, commodities are still in vogue. As I mentioned, the global cycle is still there, and a lot of these miners as well had actually cushioned themselves, or rather built up a store of cash also within their balance sheet. It's not the same for all of them, but at least some of them were holding that. So I do think there's a little bit of a cushion there. Obviously, the longer we stay in this closed straight, and we see supply side constraints continuing, as well as diesel going up, which some mines actually do use, that becomes, a constraint. But as we stand right now, I think South Africa still looks like it has some opportunities that you can still invest in. But I maintain what I said on the global side to say it's still very much of a sector-based idea rather than a whole buy the full index. That's how we're sort of seeing it. And we're relying on our managers to be the ones that actually go for those sectors, go for those key companies themselves, because overall, I think there are some companies that are going to hold up, but there are companies that are going to struggle under an environment that is protracted with higher interest rates and going forward. So we'd say, yes, it's been altered slightly. Our preference would definitely be that, what has happened didn't actually happen. But now that we are here, we need to be able to identify whether we have businesses on the stock exchange that can actually stand. And I think we actually do. Some are very robust. They've got good hedges. But again, the longer we stay here, the more adverse it is. Perhaps you can also give me your key takeaways as well, just as we sort of end the podcast.
Yeah, so last month when we chatted, we indicated that one of the things that we'll be watching is traffic through the strait. And, unfortunately that remains quite constrained. And what we're beginning to worry about now is that even if you see a sustained resolution and you start to see traffic flowing, unfortunately it's not going to take us back to that Goldilocks environment, right? Yeah. So yes, it will provide some reprieve. All prices are going to come down, but unfortunately we don't think it's going to bring interest rate cuts back on the table, right? Similarly, we're also worried about the situation worsening, right? The longer the strait remains closed, you're getting into production shut-ins. It becomes difficult to ramp up production a lot more rapidly. And, that just means that the global economy now has to contend with supply shortages for a much longer period. That essentially means, there's a risk that oil price increase even further from these levels. That means inflation becomes a lot higher. And that would suggest that monetary policy has to turn a bit more aggressive. And we get to that scenario where we are now beginning to worry about a recession, which is not a baseline for now, right? So, yes, we do acknowledge the two-way risk. But I think from here on, we, slightly a bit more cautious, worried about the tail risk the longer this continues. But similarly to what you said, the macroeconomic backdrop has deteriorated, but growth is still positive, and the monetary policy cycle is the tightening is just mild. It's not aggressive yet, but we do worry about things worsening from here on. No, and from your end, any concluding remarks?
So I'd say definitely this is not the environment to be smart. To try to be smart. Okay, you can be smart if you're smart. Just don't try.
Let the geniuses be
geniuses. But it's one of those environments where you have to stick with your strategy. I think the barbell, and I know we've used this many times in the past, where you hold some equities but also protection, it's back on the table for us. We're not out of the market. We don't think that is a wise decision to make. You still want to hold some equities. As I said, the opportunities are there for you to be able to do that, but you also want enough protection. I think if you want to, play this by almost like treat it like a Hollywood bets situation where you're just going to bet on an outcome, you might actually be very disappointed, because everything thus far has betrayed logic. Let's be honest. From the beginning of the year up until now, you just could not call this at the where we are. You could not call it, and so really you don't want to be clever.
So on that, actually, sorry to disturb you, there's a saying that I've heard that the market can remain irrational longer than you can remain solvent.
So exactly. No, exactly.
Yeah.
And it's humbled a lot of
Yes,
people by
yeah.
doing that. And I don't think we want to be on the end, or anyone should be on the end of being humbled by the market. So I think this is the time for you to be very cautious, and perhaps also the very cautious doesn't mean run off to cash, but cash is looking like a good protection and a hedge. And if things do blow over, which we are hoping that they will, but hope is not a strategy.
Yeah.
If things do blow over, as we're hoping, then you have enough to actually get back in, right? You've saved enough, you stored enough so that you can get back into those markets that you've been watching. And I think that's the approach that we're sort of taking. You're trying to also protect, but on the other side, you're trying to say, which markets should I actually go into when the time is right, so that those are ready for you to actually access. So if you're playing that active positioning, I think that would be great. If you're not, and you're in a fund like the funds that we have, then we get to do all of that for you. Yeah. So I think it's that kind of environment right now.
Yeah, awesome. All right. We'll conclude it there.
Yes.
Great chat. Hope you enjoyed that discussion. See you next time.
Take care.